What is up, everybody? Happy Thursday. Welcome back to Benzinga Live. Hope everyone's having a great day so far. Let's get started as we often do by taking a look at the overall market, digesting the CPI a day after that number came out yesterday morning, a little higher than expected, 9.1 versus the 8.8 estimates. As a result, the S&P 500 we have down 1.3% today. Your Qs are down about a percent. Your Dow Industrial Average down 1.4%. So value and energy, kind of your laggards today. Checking out the XLE is now it is down 3.65% today. It is now down back before the levels we were at before the Ukraine Russia war started. So all this gains that oil and energy has gotten from that war, we've now given up. Let's check out USO to get a more pure look just at oil. This is kind of where we got that big spike from that Ukraine-Russia war, of course, just limiting supply, thus bringing up the price. But I mean, energy and these oil and gas plays have just been in a free fall the past really month or so. Going back to mid-June, you look at Chevron's chart here, we were topped out at 182. We're now down to 133. So if you were stuck buying oil and gas stocks up here, I don't really know what to tell you. You're probably down a lot, but this does get interesting. So right now for oil and gas, the play is it really depends on if you think we are heading toward a full blown recession. If you think we are heading toward a full blown recession, then oil and these energy stocks, Chevron, they actually have a lot further to fall, right? If we go back to let's pull up a monthly chart and go back to 0708, you can see right here. We looked at this the other day. Chevron's stock dropped more than 50%. So even though energy stocks may be seen as safer in times of recession than some growth stocks or some tech stocks, they really don't perform well. So Brian in the chat saying oil and gas need to keep going down. So we checked out SPY, we checked out Qs, we checked out the Dow, we checked out the XLE. Let's check out Bitcoin. I was watching Bitcoin overnight. Actually got some decent action. Let's pull up. Let me refresh my chart here. All right, I don't know what's going on with this Bitcoin chart. Let's try daily, maybe. Zooming out. Oh, there we go. Finally. All right, so Bitcoin, I was watching this overnight. Bitcoin actually got some legs, got up to close to that 20. I guess it didn't really get close to 21,000. It got to around 20,000 and a half, about 20,500, and then kind of gave up some of those gains. But we've been ripping the past few hours or so, or the past hour or so. So I'm watching Bitcoin right here, kind of interesting. Good to see it just coming up with the Qs and pretty similar chart here to the Qs. If we pull up the Qs on a 15-minute, you can see we've both gotten that big spike up over the past hour or so. And this is really what I think is the market saying, okay, yeah, I mean, the inflation was bad. The CPI was higher than expected. We're going to get a full basis point hike, but things might not be as bad out there as some people think. And that's why I think we're seeing some buyers out here today. That's why I don't think we're slipping even further. I see Jimmy Hook in the chat saying, oh, don't worry about Wall Street. They will get bailed out as usual. I'm worried. It's the rest of us I'm worried about. Yeah, 100%, Jimmy. I'm not worried about Wall Street either. I do think there will be more trouble in the short term for just the overall markets in general, and that could lead to some pain for some of the biggest players on Wall Street, right? Looking at JP Morgan down 4.5% today. And this is interesting. Let's pull up a daily chart at JP Morgan. We're now lower in JP Morgan, well below our pre-COVID levels. So right before COVID, JP Morgan was trading at about $140 a share. We are now at $106 a share. So $34 below that pre-COVID level. But even going back further from there, if you go back and look at in December 2018, when we kind of had this brief sell-off in the markets and a lot of stocks dipped 10-15%, JP Morgan hit lows of 92. And that's the lowest point you have to go back, besides the brief COVID lows of $76. But really, you have to go back a long ways to find JP Morgan this low. So this is why I think that some Wall Street banks and firms may be in some serious trouble if we don't um, get any relief in the market soon. And like you said, Jimmy, I agree. I mean, 100% more worried about your average everyday worker right now. Inflation has been hitting the lowest income people the hardest, which just makes sense because if you think about people that have a lower expendable income, maybe people that only have a couple $100 a month to spend, as inflation starts eating that up, that's going to affect someone who only has a couple $100 more than someone who has thousands of dollars excess income a month to spend. So, certainly inflation is something that does hit the regular people hit us the hardest, more so than Wall Street. But speaking of inflation, let's go. We've been pulling up this page almost every day on the show recently. This is just the AAA gas prices from across the country. The states that are blue have a lower, average gas price than states that are red. So you can see in Illinois, we're still above $5 a gallon average, but down here in Texas, we're now close to $4. And if we keep up this trend, we should see these southern states get below $4 a gallon, which would be good to see. We can look at yesterday's average was 463. We are now down to 460 flat. Compare that to a month ago, it was about $5. So we've dropped more than 40 cents on an average gallon of gas over the past month. And you compare that to a year ago, about a little over $3 a gallon, still elevated, still way higher than comfort. But would I rather be paying $4.60 a gallon rather than $5 a gallon? Yep, every day of the week. And I hope this trend continues. I hope we check this site in a couple weeks and we're, close to that $4 flat or even below that. Because that will give us some relief at the there's a gasoline chart. I know, but I like looking at the states. And I like how this site gives us the yesterday average, week ago, month ago, because then we can see, okay, we might be higher than we were the day before, but we're still lower than we were a week ago. I guess you could see that on a chart too, but I like this site. That CL chart looks good to 85. Let's take a look. Let me get my Benzinga Pro pulled back up. And then just a quick rundown on the show today. We will have Steve Kalasian joining us in a few minutes here. We'll be talking some charts with Steve. And then at around 12:30, let me check. At 12:30, we will have Macro Alf from Twitter, who's one of my favorite macro follows on Twitter. We'll be talking about the bond market and the federal funds rates with Alf. So I'm excited for that interview. Easy Mike saying CL looks good. So Colgate Palmolive company. Okay, so this is Colgate and Palmolive, which is the dish soap, correct? Let's go to the overview. So this is, I know they have other brands too. Since it's founded in 1806, Colgate Palmolive is, yeah, I mean, I think consumer staples right now are definitely going to be safer than some of your other growth stocks. Let's check back in on the Qs, just see how we're doing. Oh, wow. Holy cow, Qs. Look at this candle. Let's go to a 10-minute chart. Qs just kind of pushed up on us. Qs came to play today. They said, not so fast. We don't care about you, Mr. CPI. We don't care about inflation. We're just going to keep going higher. This is interesting. Yeah, man. Wow. I mean, the Qs look like they're trying to push to green. We're now down only 0.4%. I just realized we never played that intro. Let's go ahead, roll that intro. And then here in a few minutes, Steve Kalasian will be with us.
This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wujasek from Trend Spider. We have a breaking news.
All right, Google AB, let's take a peek. All right, let's do it. I like Google here. I mean, this is a stock that, the stock's about to split, but Google to me, sorry, this is a 10-minute chart. Let's pull up a daily chart. Google to me, I mean, has one of the best moats out of any of your big mega tech companies. I mean, Apple too. I mean, if you think about Apple, obviously has competitors, but Apple's, consumer base is so carved out at this point. The people that buy Macs buy Macs. People that buy iPhones. But Google, if you think about different parts of their business, really don't have a lot of direct competitors. I mean, for its core like search engine business, not a lot of competitors. It's advertising business. Facebook, Amazon also taking a lot of that advertising money. But what I've been seeing is that a lot of advertisers are actually ditching Facebook right now. And it's not just with like ad cut spending. It's even before that. Kind of people were starting to slow down on ad spending on Facebook, which I think is bullish for Google. So you have the split coming up, and you also have to just consider, I mean, this stock is down from 3,000 a share to around 2,200. So it's almost 30% drawdown here on Google. So this is, could be getting pretty interesting here at some point. I would not mind adding Google here for the long term. I would say, just depending on your time horizon, Mike, like if you were looking to buy and hold something as a swing trade for, 4, 6, 8 weeks or so. I don't know if now is when I would buy. I think I would wait. Because I mean, if you just look at the chart here, and again, this is a daily chart, we're trading in this range. We're kind of barcoding here, right? Getting down to we hit this 20,000. Although I will say, if we zoom in on this chart, it does look like each time we're making higher lows. But I would wait for a breakout, and then if you miss out on a couple percentage points, so what? But just for a swing trade right now, I wouldn't be surprised. I mean, Google reports earnings on the 26th. Personally, in this environment, I would want to wait till after earnings, just because there's a strong potential Google and some of your other biggest companies come out and say, oh yeah, this wasn't really a great quarter, yada yada. The stocks come down a little bit. Check back in on okay, looks like the spies came back down a little bit. Qs as well. Let's go to a 5-minute chart. Yeah, I mean, you can see just this one big green candle we got. But the trend has been here. I mean, since about 10:15 in the morning, we hit lows. The Qs got down below 280, and we've been ripping almost 4 handles since then. So pretty good intraday movement on the Qs here on the SPY. So we'll keep watching the indices here, keep seeing if we can push into the afternoon. And I wouldn't really be surprised. I mean, let's pull up our CME Fed Watch tool, which I was watching a lot yesterday because the odds were bouncing around on the Fed future swaps for what the next rate hike will be. We are now, and let me get it. Oh, wow. Holy cow. Okay, no wonder the markets are ripping. Holy cow. So this was 80% earlier today, an 80% chance that we would get an 100 basis point hike. And now that's down to 50. So something has happened today. Something has happened in the last few hours that has made the market more convicted that, or less convicted that we're going to get an 100 basis point hike. Let me go ahead and get the, let me see if we can find this headline in Benzinga Pro. This will be actually really interesting to talk to Alf about here in about 45 minutes because this is something that he's watching a lot. Let's go to SPY, go to overview, go to news. Fed's Waller says yesterday's inflation was not a big surprise, says to go above 75 basis points, needs to assess data. Waller says for me, 75 basis points gets us to neutral. So it sounds like the Fed, or at least Waller from the Fed, is saying, guys, don't get too ahead of yourselves. An 100 basis point hike isn't baked in yet. It's not ready. We're not ready to make that call today. So, I mean, look, I don't think, I mean, I think even with a 100 basis point hike, there'd still be buyers down here because there's also the flip side to that is, okay, that gets us to rate hike, or that gets us to rate cuts quicker. Guys, I see some tickers flying in the chat. Let's check out Baba real quick, and then let's get our first guest of the day, Steve Collation, on. We'll be running through some charts with him. Ooh, Baba news, bad news. Alibaba executives called in by China authorities over police data theft. More than a dozen other databases hosted by Alibaba suffered similar vulnerabilities. So it sounds like it's honestly kind of crazy just how similar Alibaba and like Amazon and stuff is. Like Alibaba, like Amazon, runs these cloud services in China for companies and for government agencies, obviously. So sounds like maybe they had some uh, data breaches in those cloud-based services. Not good news for Baba, not good news for Baba holders. Let's check out the chart here just because, I mean, yeah, that's ugly. That's in the past 10 minutes. We've gotten this big leg down. And this is a stock that's actually been performing pretty well. So maybe this is one of those times where you can buy the dip on some bad news because the stock has been in an uptrend. But I think there are a lot of risks, a lot of fears out there with China. So, maybe if it were me, I'd be looking at some non-Chinese names right now. All right, guys, let's go ahead and bring our first guest of the day on. Let me go ahead and get my headphones on. Let's give him our very special intro, and let's get Steve Kalasian on the show.
This is Benzinga Live.
Mr. Kalasian, how you doing today?
Hey, Aaron. Good morning. Good morning, everybody.
What is up? Were you trading the CPI print yesterday?
Oh yeah, we had the the pretty in the morning we had some buy divergences and we caught a buy reversal yesterday. But you can see how the market reacts every time a Fed governor talks. And to me, this is just ludicrous. Waller just came out and said that we were at probably like an 90% that we're going to have a 100 rate hike in the next meeting. And then he comes out and says we don't want to overshoot interest rates here. You got a 41-year high in inflation, and they're not even touching the tip of the iceberg on trying to reduce inflation here. Remember, I told you on the last show. I remember going back years ago when the Dow was around 10,300. Fed funds were at 4.5–5%. They're not even thinking those numbers in regard to here. They don't want to split the markets or do anything catastrophic to the markets. But yet the American people are really suffering here because inflation is way out of control. And when you have a governor that comes out and says that, we don't want to overshoot, and now the odds drop from about 88% for a 100% rate hike, now you're down to 50-50 for a 50% rate hike in the next meeting. The markets took that as a bullish tone. And, again, their mandate was 2%, right? And they completely ignored the numbers for months, several months. And until finally inflation hit the 8.5, now 9%, the highest CPI number yesterday in 41 years. And they're still talking kind of dovishly not to battle the inflation to the American people. This is just not right.
Yeah, and I mean, I've talked about this a lot on the show just right now, how the Fed is in a very tough position because there are a lot of people I see shine in the chat asking how would the Fed reduce inflation. That there are a lot of economists out there and people out there saying, that by raising rates right now isn't going to do anything to bring down something like gas prices or whatever, because it's more of a issue on the supply side than the demand side. I think the counter to that would be you can definitely bring down the gas prices and stuff by raising the rates high enough. That would come with a downturn in growth and a rise in unemployment and a recession.
Well, that's the thing. So, like you said, the Federal Reserve is stuck between a rock and a hard place. One, they don't want to overshoot inflation. They don't want to overshoot raising rates because one, it's going to cause a recession. Two, it's going to hurt the stock market, right? So, but yet, the only way to combat inflation is by raising rates, right? You're seeing that right now. Oil hit below 91 today, right? You're seeing commodity prices like gold and oil, right? You're seeing what they're telling you. We're going into a recession. Commodity prices are getting killed, right? So when you see oil, even though oil rallied 3 off the low, right? You're seeing that the commodity prices are telling you that we're going to go into a recession here. And that no matter what, the Federal Reserve doesn't want to spook the markets on the other hand, but that's not their job to worry about the stock market, but yet somehow they seem it is. But they just fail to realize that Americans are struggling here. Food and energy are through the roof here. I mean, you have lumber. You have, every time I talk to somebody, it's just the costs of things are just skyrocketing. And how could you be so ignorant not to see that, in the real world? We live in a real world. People have to spend money to buy certain products. Milk has gone up almost 30% from the time I remember a year ago. All right. So if milk goes up 30%, think about meat goes up and wheat and all the products that people buy each and every day. They have to raise rates here, but they're being very, very cautious on their words because they don't want to spook the stock market, because the market will drop 5,000 points in no time.
Yeah, and I think at least, and certainly prices are still way too high for comfort, but this is the USO, United States Oil Fund chart pulled up, and there are a lot of commodities, oil included, that are now well off their highs. So I think, for the Fed at least now is in a position where they can see some data and saying, okay, maybe inflation is slowing down a little bit, and maybe that can give them some give them some ability to say maybe we don't need a full 1% hike on the next
Yeah, but you're still way
meeting.
behind you have the highest inflation in 41 years. Back in the 80s, you had 18% interest rates, right? I'm not saying
Right, but
there.
but Steve, if you were an everyday worker, say you're a mechanic, whatever, what's worse for you, paying an extra 30% on milk, or if the Fed rates up, brings rates up too high, causes a recession, you lose your job. Now you don't have a job, and milk is still more
I said
expensive.
this because what the Federal Reserve failed to do is, as the numbers were coming in for several months, for almost a year, they should have raised rates gradually along the way, and they failed to do so. If you look at the last probably 12 meetings, they did nothing at all. They just sat on their hands.
Yeah. I mean, I personally, like, I wouldn't mind them sticking to the 75 basis point hike right now and then saying, let's wait till the next month's CPI print. If that comes in higher than 9.1, all right, then we'll go full, scorched earth and raise rates as much as we need to. But right now, I think while you have at least some data out there showing that inflation could be coming down, maybe that gives them enough ability
Yeah,
to
but coming
hold off
down
on
what
that.
from Adam? 8.5%, 9%. Where are you going to come down to 7, 6.5, 7%? Their mandate is 2%. And to take an aggressive tone, and they have not taken an aggressive tone. They just sat in their hand for several quarters while rates were while inflation was that high, the highest in 41 years. That's astronomical. The American people are really feeling it. Now they're going to feel it when we're in a recession. Don't get me wrong, and I'm hoping we don't go there. Right? But commodity prices are clearly telling you we're going to go into recession. Oil will drop. Look at that chart in the USO. It's almost identical to oil. Right, so oil prices are have got cabooshed, right? So oil is telling you that we're going to go into recession, that there's an economic slowdown coming upon us.
Yeah, and that's why, I mean, I've been watching energy and oil today 100%, and like I said earlier on the show, I think now is actually a very interesting spot. If we want to pull up the XLE or something like Chevron to look at it as well, because we've now given up all the gains that energy got from the Russia-Ukraine invasion. But right now, I think is an interesting buying opportunity if you think we aren't going to go toward that full recession. If we aren't going to go toward that full recession, then gas is still going to remain high. These oil companies are still going to make a lot of money, and could be decent buying opportunities here. If you think we're going to a full recession, then yeah, forget it. Then it's going to drop another,
I
it's going
think
to come
oil
all the
can
way
get down
down
to
here.
65. I think oil can get down to $65, $75 a barrel, and then we'll watch it from there. But there's really no support until the 65, 68 range right now. So I mean, and that would probably bring oil prices below $4 a barrel, or maybe $4.20 a barrel, but gallon. I mean, I think they did this themselves. Again, if they had just started raising rates gradually, right? I think that would have been the tone, and then for a Fed governor to come out and say this, you got to look at the American people. I mean, I speak to people each and every day. I mean, from all around the world, and people are feeling the pinch, And so if you're making, say, $100,000 a year, I'm just giving you an example, and you got 9% inflation, well, that taps into that earnings of that person. You know what I'm saying? So they spend less. They don't have income to do other things. People aren't going to travel as much. It's just going to be a domino effect. So once that 2% mandate was surpassed, and they just sat on their hands. I think they were just hoping that asset prices would keep going up to the point that it would just balance out the rise of inflation. But when the S&P futures dropped from 4,800 down to 3,600 and change, well, it backfired on them. They dropped 1,100 points off the highs. So asset prices dropped and inflation stayed high, and now they have real big problem on their hands.
Yeah, and I mean that's why like I said, I think right now with what the Fed can do, I don't know. There's a lot of argument out there about like how much would rate. I mean, think about it. The Fed started raising rates 3-4 months ago. Inflation's only gotten worse. Like there's a lot of
Right.
data and people arguing out there saying that right now the Fed jacking up rates actually won't do much to limit inflation outside of creating a recession, which
because rates have come from so low that they're not making the negative impact on inflation. So Fed funds really should be around 5.5%, 6%, maybe 7% to start really tightening. And imagine with that one, you'll have an S&P at 2,600 if that happens.
Yeah, I mean 100%. If we see Fed fund rates above 4%, I expect that the S&P and the Qs to fall a lot.
Right. So going back to your last statement, right? That yes, the Federal Reserve has raised rates in the last 3 months, but not enough to be effective upon inflation because it's so late. They're so late to the game. That's like going to a ball game. The Mets are winning 5-0. You go there at the top of the 8th inning.
I know, Steve, but the point is that there are, if you look at right now what's driving inflation, right? High gas prices, all these things that there are people out there that are saying, economists, that as the Fed jacks up rates, what's that going to do? It's going to slow investments into new gas production, all these things. It makes money tighter, and that's just going to limit supply even more. So they're saying it could have this, it's like that this inflation we're seeing may be different than inflation in years past. So there's a lot of, I don't think it's as simple right now as raise rates above 4.5%. I think we'd be in a lot of trouble if we did that.
I don't know if I agree with that. From my years of experience, I don't know if I agree with that. But I do think that the rates that the rate hikes that in prior months have been so minimal compared, because we were at 0 for such a long time, or 0.25%, that it's just baby steps. It's not really anything combative against the real problem. Now I see what everybody's saying. You raise them so high, and then you're going to kaboosh the economy. You're going to get the economy in such a downward spiral where restaurants will be hurt. Every aspect, and nobody's going to spend any money because you're going to go into recession. People will start losing jobs. I know it's a quandary. But they did this. They sat on their hands way too long. They jump up and down for decades saying that inflation 2% we can live with, 2% we can live with. But when the data that was coming in for month after month after month was 3%, 4%, 5%, 7%, 8%, 9%. And then at 8%, they started tightening a little bit, but not enough to move the needle. So they really put themselves in this bind, in my opinion. They could have probably at 3%, 4%, probably could have raised it 1.5%, 2%. And then that could have tamed it to a degree, maybe, per se. That's all I'm saying.
No, and I agree with that. I think if you gave, Jerome Powell and the Fed a time machine, they'd go back and probably start gradually raising rates, doing some quarter, 25 basis point hikes here and there, and getting rates higher than 0. But definitely a lot of just uncertainty. I think, like Andy's saying, it's a supply issue, end of war. I think when the Fed was making these decisions a year ago, didn't foresee a international war or anything. So I agree 100% that they waited too long and are now dealing with those consequences.
Like I said, it's just a wait and see approach, right? We have to see, but they're not. I mean, you had a couple of rate hikes in the last few months, and you had the highest CPI in 41 years, let's say. So it's there's nothing that the rate hikes have shown zero impact so far.
Yeah, well, I mean, so take something like semiconductors, for example. For a long time during COVID, there was a big shortage of semiconductors, and that was, causing slower production of cars, limiting the new supply. So that was actually driving inflation of new and used cars, was this shortage of supply chain. So there are people out there that have just been saying, okay, to help fight this inflation, we need to produce more semiconductors so we can get those new cars out there, get those new appliances out there. And we need more investments in the semi space to do that, not less. Well, now the script has kind of flipped, and now we have a surplus of semiconductors because people all went and rushed to produce those. So hopefully that will lead to some sort of relief on the inflation front. We shall see. I'm not quite sure.
Yeah, like I said, it's a wait and see attitude right now.
Brian Blockchain in the chat saying we can't blame the war. We had 7 or 8% inflation before the war started. I agree, but I think I don't think you would have seen as elevated gas prices
I
and
agree
other
with
energy
Brian 100%.
prices. Here we go.
I mean,
today's Fed speaker.
I think when the war news came out, I think oil was 48. I think the American
what was 48? You said?
from what I'm hearing, is like they're just. I think when the war started, I think crude was on 48 or 50 a barrel or something like that. 38 or I forgot what the number was. 38 and a half, 48, something like that. But I think, I talk to people all around the world each and every day, and I talk to many Americans. I think many Americans feel very, disheartened by the Fed's actions here. I think a lot of people feel like the Fed only cares more about the stock market than the American people per se, And I talk to people all around the world, and even Europeans and people I talk to from other regions of the world say the same thing. But again, I don't want to talk politics or anything like that. But the point is that was their job to mandate 2% inflation, and I think they failed miserably at that.
No, yeah, I mean, 100%, no doubt about that. And if you look around the world, I don't think there are a lot of countries out there that have been able to, fight this inflation we're seeing. But I think to that point, to the Fed caring more about the stock market than the people. I mean, I think whether you look at it, whether it's the way I see it is that if the Fed, hikes rates up enough to really bring inflation down and thus bringing the stock market down, that's also going to lead to higher unemployment. Which the Fed, by the way, has basically come out and said we are basically going to try to tackle inflation at all costs. Like they're willing to take on some unemployment, some pain in equities, some pain in assets to fight this inflation. So we'll see if they follow through on that.
Right, then you just had the Fed governor speak 25, 30 minutes ago saying that they don't want to overshoot rate hikes either, and
Well, yeah, I mean, I think he was saying that they haven't committed one way or another to 75 or 100 basis points on the next hike, and I think whatever they do on the next hike, it's going to matter for the stock market. It's going to matter what we're doing, but in the long term, it's going to.
I think 175 or 100 was priced in. 50 is not. 50 is bullish.
Well, I think it's between 75 and 100. But yeah, 75 probably would be bullish, or even 50 if they go surprise to the low.
50 would be, they'll rip 100 handles like nothing.
Yeah, but I don't think the Fed's going to go to 50. I think it's here.
Well, the odds has dropped about 25% in that last statement.
Let me pull this up. Yeah, so I've got the CME watch tool here. Yeah, it's about a 50-50 shot. So we're current.
You dropped even more just now. Look at that.
Yeah, so if you look yesterday, we had a 20% chance of another 75 basis point hike. Now that's jumped up to 50. So yeah, the odds have come down on 100 basis
points. 25%, as I said.
Yeah. So what have you been trading the past couple of days?
Well, the same names, all the big caps, the Microsofts, the Apples, the Teslas, the Amazons, the Boeing, Goldman, all the 4 ETFs, the Spiders, Diamonds, Qs, Russell, the indexes. Square, Roku, Meta, all the big caps. We do the same names every day.
Yeah. How about Boeing had a nice move the other day. Were you trading that on the
Because they got a
upside?
big, because they're expecting 131 new planes for this year, or big order.
Yeah, I mean, is Boeing interesting down here? I'm looking at a daily chart right now. It looks like we hit lows mid-June around
117, I think, was the low.
Yep, 116, 117. We've come up. We're at 144 right now, so not a bad move in Boeing over the past few weeks.
But look at all that overhead resistance you got on Boeing here. You know, I don't know if I don't know if the lows are in, but probably 60% the lows are in for the year. And if we do get a sharp pullback on Boeing, I probably think that it's going to make a higher low. It's probably one of the names I would look to accumulate if you're a long-term investor. If you do get a flush out in the markets in the next several months.
Yeah, I mean, Boeing's just one of those that's always interesting to me because it obviously doesn't have a lot of competition, just Airbus and Boeing. But obviously a lot of problems with this company, and I mean the chart's been ugly since even before COVID. If you go back before COVID, it was, hit highs of 440. This is where we got all the problems with the planes that were crashing, the 737 Max, and then been in a big downtrend, even while the other overall market was doing well.
This is a great trading stock. I mean, a lot of people in my community traded viciously all day long. And even this morning, today, we had some buy divergences on it that ran, well off the lows. So it's a great trading stock by far, especially if you're intraday trading.
Yeah. So what have been some other ones that have been making good moves recently?
Well, Apple, let me just turn around here. Okay, S&Ps, the lows are in for the day. So I'm getting big buy reversals here. So based upon the comments from Waller, the lows are in for the day. I think we hit the 23 on the S&P, and NASDAQ was the 18 3/4. So right now the NASDAQ, about 160, 170 off the low. So I think the lows are in for the day. I'll be looking for pullbacks here for buy entries, just to trade intraday trade now. But overall,
wait, so you have more experience and you're better at looking at charts than I am, but I'm looking at the Qs on a 5-minute chart right here, and this looks kind of toppy to me up here. I mean, it looks like we had this big green candle. We couldn't clear up here. We tested these highs. We got rejected, and now we're down here. Like, if I were going to play the Qs right now, I might look at some puts.
I think we're gonna get a nice pullback here and get another push up.
Okay, so maybe on the next pullback, like if we get down here, then I should look at some calls.
Yeah, I think right now I think the lows are in for the day. I'm gonna be looking for buy strategies here.
All right, well, I might be joining you because the past like 3 times you've been on, Steve, you've absolutely called what was going to happen the rest of the day to a T.
Well, it's August 1st. I'll be doing this for 39 years. So I spent 9 years of my life building my software, and I want to be right 90%, more than 90% of the time. So I'm not in this to do this for anything less. So I studied the technicals. I built my own technical application. I teach this each and every day, and I think we're gonna get pullbacks, push up. I think the way to trade the market now, you get a couple really good buy divergences on pullbacks. You may get 1 or 2 sell divergences towards the end of the day, but the lows are in for the day right now in my book.
Yeah, and so do you think we could go green on the Qs?
Let's see what we got. I don't know about going green on the day. I think you'll still be in the red, but doesn't mean that you can't take long positions in this. You know what I'm saying? You can't trade from the long side, especially if I feel that the lows are in for the day, based on looking at my work right now.
Yeah. Super SPAC Man's asking when options expire. The monthly options for July are actually tomorrow, since I believe
Friday.
Yeah, this Friday. But yeah, but every week, Super SPAC Man Friday. Well, for the indexes, for like the Qs and SPY, you have options that expire Monday, Wednesday, Friday. But typically for most stocks, just every Friday. Do we keep this momentum till tomorrow? What do you think, Steve?
The trend down or the buy reversal was the asking?
I think he's asking to buy reversal. This momentum in terms of the chart, the stock's coming back up.
That's why you don't hold positions overnight. I think there's enough money to be made during intraday. I think probably I probably think 60% that we may follow the trend back up tomorrow on this. I think those were bullish comments that came out. So I think that even though we may be down on the day, but the lows are in for the day, you may get another pop tomorrow morning.
Yeah, and I'm checking the future fund swap rates again to see if we've gotten closer. If people think we're going 100 or 75.
No, we're going 50.
All right, Steve. Where can folks find more from you?
www.tradeeasy.com. Come join me each and every day from 9 to 4 on my live channel.
www.tradeeasy.com. I'll go ahead and throw that link in the chat. And guys, if you're newer to trading or you want to learn, Steve's your guy. You got to go to Steve. Like Steve said, in August, he'll be doing this 39 years. So you want someone with experience. You want someone with a high win rate. Go to tradeeasy.com. Check Steve out. Steve, any final words today?
Just thanks, Aaron, for having me, and really loving the show, and keep up the great work. Trading is my passion, and I just tell people, my years of experience and what I teach here is just to be consistent, maintain the 5 words, consistency, discipline, confidence, patience, and passion. And, let's just go for singles all day long, singles and doubles. I don't like home run hitters, So I think there's enough money and volatility. I think the markets, one thing that never freaked me out was volatility as a trader. You have to learn to adjust different markets. Sometimes markets are just flat, and then you get these wild, crazy days. So, we're very, my research shows me out of 22 business days in a month, you'll get 10 trending days, 10 reversal days, and 2 days that are, might as well just go to the beach, and you can identify those days early in the morning. But I love it. I'm blessed, and I love talking to people all around the world. I love helping people. I want to help change their lives. And thanks for having me on, Aaron. I really appreciate it.
Of course, Steve. We appreciate you coming on. Always great to hear what you have to say. And just by the way, I mean, I don't ever mind. Sometimes I'm going to disagree with some of my guests on certain things, and I think that's good. I think that's productive conversation. It's better than having people on that all think and agree and say the same things every time.
I agree.
All right, Steve. Well, enjoy the rest of your Thursday. We'll see you next week. Till then, stay green.
All right, brother. Have a great weekend. Bye-bye, everybody. Thanks for having me, Aaron.
Thank you, Steve. All right, guys. Again, that is tradeeasy.com. We've got that link in the chat. Go ahead and check that out. Steve is a great guy to learn some charts from. We've got our next guest hanging out in the chat. I don't really know who this guy is, but let's go ahead and give him our special intro anyway and bring him.
What's up?
What up, Z-Man? How we doing?
Z-Man, that's a new one. I like it. Good, man. Just hanging out, watching the markets. It's been a fun day. It's been a slow day in the morning, but now we're kind of ramping things up here.
Yeah. So do you think we can go green on the Qs?
Do we go green on the Qs? So what are we down? A little bit more than 1%? Oh, man. I don't
think
so.
No. We're only down 0.5%.
Sorry. I meant, yeah, 0.5%. I'm looking at the SPY. My apologies. I think we're going to end up testing 283 here. Matter of fact, let me share mine. That way it's a little easier on you.
Okay.
Let me share mine. And matter of fact, I'm going to have to go grab my phone here in a second. But there are my charts. There's that. I think we kind of come back and test this 283 and then possibly VWAP and then maybe make a move up because we've just been going up and up and up since the 280s. And you can see my little crayons there, a little bit of resistance. But I think we go a little bit lower, give a chance for the folks who missed it to get in, and then we can go a little bit higher. I'm currently in Tesla right now. Off of VWAP. So I'm hoping for this breakout over 708. I've got.
You're in Tesla long right now?
Yeah, I literally just before you pinged me sold my equity at near 705-ish, but I am in Tesla 705 calls. I got filled at 1066. Currently they're trading for $10, so I'm down 6% on my calls. I'm going to sell if we get to 696, or if we can go ahead and at least test this previous close again, which would be the high a day.
Okay.
Or retest the high a day. But that's the game plan for me right now.
Yeah, that's interesting that you're bearish on the Qs, but then bullish on Tesla.
So the main thing is, you asked me the question of, do I think we'll get there? My main thing is, I'm not saying we won't. I'm saying I would assume we come back and test this EMA and then go back up, right? So
But if
same
we
thing
come
with
down
Tesla.
and if we come down and test that moving average, Tesla will probably come down too a little bit,
It
right?
probably will, but as long as it doesn't break VWAP, I'm okay, right? So
Okay.
VWAP is kind of like my guardian angel, if you will, in this scenario. So if it wants to come back and test 700 or even 698, that's okay with me, as long as we don't break it. And if we don't touch 696, that's why I gave myself a couple of bucks below VWAP. I think we should be perfectly all right.
Yeah, and then so basically you're willing to sit on like a 10% loss on the contracts before you.
I'm already down about 6% right now. I am realistically expecting to lose 30 to 35% if I'm wrong, right? So I know that I've got $1,000. Let's say I've got only one contract. So I know I've got $1,000 position. If I'm wrong, I'll lose about 300 bucks, which is typically my profit loss on some of these situations, especially when we get closer to Friday. Those contracts move wild. So I'm very careful with the position that I have. So that's what we're rocking with right now. But let me do this. Let me go ahead and try to find my phone, because I know I've got something coming up at 12:35, and I'll make sure it doesn't get canceled, bailed, whatever. But I'll be right back, and we can talk about more stocks.
Sounds good to me, brother. All right, let me go ahead and get my Benzinga Pro pulled back up. If my computer wants to let me, there we go. All right, still watching the Qs here on the 5-minute chart. Does look like we're forming a nice little green 5-minute candle here. So pushing higher on the Qs. I don't know. I mean, I think right now this candle will be the biggest question. This 5-minute candle where we went up 0.4%. If we drop back down to here and test these lows and start coming higher, then I expect the Qs, like Steve said, to keep moving higher throughout the rest of the afternoon, that the lows could be in for the day. But if we get down to this level and break through that, then I think that could be kind of short-term bearish for the Qs. We shall see. I'm going to look at the Qs toward the end of the afternoon to see if I see any like calls or puts that I think are attractive going into tomorrow. Just because I like to do that on Thursday afternoons, look at like basically 0 day till expire options that can be nice little YOLOs going into the close. So I'll let you guys know. Looks like we are getting a nice little push up here. Zunaid, go ahead and take the charts back.
Yeah, I mean, the main thing that we were talking about was you just talked about the Qs, right? So let me see if I can give a different perspective possibly on the Qs. But look, here's Tesla again. The yellow line is the previous close, the pink dotted line right there. But let me talk about the Qs here. Similar story where, again, we're trying to test this through two. One thing I need to do a better job of, AB, is write text on what these drawings are, because so many times I just draw lines and they help me out, but like it's like, bro, where'd you come up with these fancy drawings? What do they even mean? You know what I mean? That's one thing I got to do better of. But anyway, you can see these drawings were made well before, and we've kind of hit resistance right there, and I expect us to come back. But I will say this, AB, because I don't have a position short on the Qs, I am perfectly okay being wrong here, as long as Tesla wants to ramp up and try to hit the 710s.
Yeah, I mean, if you have open Tesla calls and the Qs keep ramping higher, I imagine you're going to be a happy boy, a little
I'm okay with that.
A happy man.
You know who else is a happy boy and a happy man? It's Mitch. Mitch and I took this trade. I already got out of it around the 450s with all of my trades. But I believe he's still hanging on, or he pinged me on Slack and he said, this is where we sell. But he's on GOV. I think he got this one in the morning trading show around like 380s, let's just say, around here, around this little area. And he's been enjoying the move up. I know he's been scaling out a little bit, but I think he finally took his final piece around here. I could be wrong. Maybe if he's in the chat hanging out, he could let us know. But this has been a beauty. Hopefully some folks in the chat got a chance to take advantage of it. And you can see the EMA held here, right? Dip, buy, EMA, over VWAP, go, go, go. This has been a fun one. I don't know if anyone in the chat's played this one or not, but Apple, dude, look at this move. Look at this move on Apple. Just crazy. Crazy move to the upside. Crazy, crazy, crazy.
Holy cow.
Crazy. You a crazy girl. Whatever that TikTok is.
I should have bought some more Apple. What's Apple at right now? 145?
147, my friend.
Holy cow.
Yep.
What a move.
Yep. What a move indeed. We drew this little trend line, excuse me. I went short Apple like a dummy, paid for it, lost about 20% on the contracts. It is what it is.
Yeah, you never go you never go short on Apple.
Yeah.
Well,
We
you can.
went
You can.
short. We went short yesterday near the 145s, I believe it was. And it paid off really well. You know, it worked out. But regardless, man, something I do want to talk about, the 145, just to give another example. We often say support turns into resistance, resistance turns into support. 145 kept being resistance. Then we finally broke above it. But look at this second candle here in the yellow box. Then you come back and test it right here with this wick. It holds, and then you continue your move higher. So it's cool to kind of get a breakout, but it's like, hold on. See if it gets a retest. That way your risk reward can be a little bit bigger. Because if you would have bought Apple on this break, on this 10-minute close, you're buying it at 145.50. You're paying 50 cents above the breakout price. But instead, if you waited, you could have gotten it closer to 145.10. So you're saving yourself the opportunity cost of not losing money by 40 cents. So it's a little bit cleaner that way. But regardless, I am not in Apple. Didn't get a chance to play this one after it broke out because I didn't expect a $3 move, AB. I just didn't. What's on your t-shirt? What you guys saying there?
It says Belle Isle. It's been grand. So there's a little island off of Detroit called Belle Isle. And we had the Detroit Grand Prix at Belle Isle for like 20 years. And next year it's moving off the island. So this was the last year. So it's a little pun. They're like, Belle Isle, it's been Grand Prix. This is the last year. You get it?
Yeah, I do get that. Spencer went to a really beautiful place, apparently, somewhere in Detroit. Didn't think Detroit had scenery like that, but he found some nice spots there.
What are you talking about recently?
Yeah, I think he posted it on Twitter. On the Twitter. Yeah, it had like mountains and falls and shit. You know, the
it might have been like northern Michigan, not Detroit.
Oh, come on. Come on, Tesla. Hold the 700 as a first line of defense, and then the 698 as a second line of defense.
Yeah, let me check out my calls, see what we're doing today. All right, Zunaid, I know you have to go in a few minutes, but if there are any other stocks you'd like to check out beforehand, by all means, let's do it.
Man, these are the only ones that I'm kind of paying attention to. You can see the Qs coming down just a little bit, nowhere near enough to impact what I was saying earlier, but NVIDIA just kind of in this little consolidation range. But I want to go to the weekly on SPY and talk about how we were until the drawdown this morning and kind of like an inside candle on the weekly, but now obviously we wicked below it. But here's a trend on the weekly, just 3 weeks. You can see it's obviously to the downside. So if you're going to try to go ahead and play short, keep an eye, make sure you zoom out, look at the hourly, look at the daily, look at the weekly, get an idea of where we're at, and use your crayons, draw some trend lines and see what works, some doesn't. But that's kind of about it. Any positions you taken that I should blow my money on?
I want to wait till, like you said, the Qs get down to that VWAP potentially, and then I might look at some longs just because I think, we're getting a little overextended here, especially if we get confirmation from the Fed that we could be going below an 100 basis point hike could be bullish for the Qs. Looking at Tilray got a nice bounce, huh?
Someone mentioned in the chat, so I just want to take, this has to be a news base. This isn't just trading. There's no way.
Let me check real quick.
So I wonder what's going on that side of things.
I'll get you a quick answer here. Go to the Cannabis and Psych News Desk for Benzinga. Let's go on Benzinga Pro. That'll be
Is there a Senate vote possibly?
Potential. Tilray up 13%. Let's go to overview.
Yeah, it looks like a pot discrimination bill ready for Senate introduction.
Yep, from Bloomberg. New York marijuana regulators approve rules to start accepting retailer applications. So yeah, sounds like there's some bullish news in the cannabis industry.
Yeah, so how do we play it, right? You got to wait, in my opinion. The closer you get it to VWAP, the easier your profit target and your risk reward will be. So the closer you get it to like the 340s, 345s, maybe it could work out for you. IMCP, I think is.
Wait, so many beats. Easy 400% play. Did you know this news was coming? How'd you make
hold
a 400%
on.
play?
You didn't share the inside info with us? What's going on?
Yeah, come on, man. I thought we were boys. I thought we were buddies.
On? I thought we beat the market together, not just you.
Well, how'd you play that though? You had calls that expire tomorrow?
Well, let's see. Tilray. The only way I see him playing that is if he got it around this pop in the first 5 minutes and then he saw some upside movement. Probably bought $4 calls, possibly. Or no, 350 calls, maybe. Because they went in the money from out of the money.
Dustin saying it's Germany. They might legalize. That could be potentially too. But I don't know if Tilray does like business overseas. I don't really know. I don't really know a lot about a lot of these marijuana companies, to be honest with you.
Yeah, I've got no idea. Ugh. You got any calls for tomorrow? Anything you're doing? Anything you're playing? Sorry, I interrupted you earlier, I think.
No, I like I was saying, I want to look at some Q calls if we do keep moving a little lower potentially. So we'll see.
I gotcha. Yeah,
It
Tilray
does look like
on the Canada side of things. There we go. Come on, Tesla. Just hold a 700, buddy.
it does look like we're coming down to test these level. Can we pull the Qs back up so I can see them on your moving averages?
I sure will, my man. I had it on the 10-minute earlier, and boom, what do you know? So there's that first target, if you will, that we talked about on the Qs, and the second one possibly could be VWAP. Now, I will say this. My greedy and selfish self, I'm okay with the Qs stopping what they're doing. You already proved me right about half of it. You ain't got to keep coming down because now my contracts on Tesla are down 20%, and now I'm down about $200. I was already down 400 on the day.
See, that's why I was
I'm looking at
confused because I was like, if you think the
$5,000
Qs are
out.
coming down, then why the hell are you holding Tesla calls?
Well, no. Again, I was answering your question of do I think is going to go green to red, or I mean, excuse me, red to green. And I was like, maybe, but I do believe that it's going to come down before it goes back up. But regardless, come on, Tesla.
What's the VWAP number at for the Qs?
6. Oh, for the Qs. I don't know why I said it in such a harmonic way, but it is approximately 282, slightly above 282.
Oh wow! So we would come down a bit from here to get down to there.
Yeah, I think I'm gonna end up selling my calls though because I'm already down 20%. Let me see. Let me see what Tesla does. VWAP is right there, bro. It's fine. If I lose another 100, I lose another 100.
All right, man. Well, it's 12:30. If you got to run, you got to run.
Yep. It's always been a pleasure. I think you and I might work on boot camp next week on Wednesday. I just got to ping about it, so we'll link up shortly, pal.
Hell yeah! Wait, where's this ping at?
It would only ping me because you're already doing it.
Oh, all right.
Or at least I thought you were doing it, but
I probably will be doing it.
Yeah, it'll be interesting because I'm not in the office, but we'll figure it out. Cool. Good luck. I see your guest is here, so I'm gonna see myself out, my man. Don't lose too much money, but have fun.
Oh, that's not what we do. Not on this show.
No, yeah, of course not. See ya.
Never. Peace. All right, y'all. That was Zunaid. Go ahead and smash the like for Mr. Zunaid. Always good to get him on the show. Before we bring on our next guest, let's do another quick check just on the overall markets. Let me get my Benzinga Pro pulled back up. Let's see. Okay, we were still looking at the news feed here on Tilray. Sorry, my computer's just being a little bit buggy. All right, cool. Let's go to the S&P 500. Your SPY is down about 1 1/10%. Yeah, so we're basically 50-50 on the 100 basis point versus the 75 basis point after Waller's comments. The CME Fed Watch tool is showing. I've been watching that as well. So I'll let you guys know if that changes. But for right now, it sounds like the market really doesn't know. The Fed future swap rates are actually now it's ticking back toward the 100 basis points. So maybe that's why the Qs and the SPYs have come down a little bit. But let's keep ticking through. We've got the Qs down about 0.75%. Your Dow Industrial Average, kind of the laggard of the day, down 1.22%. And Bitcoin up over the last 24 hours about 0.2%. All right, guys, let's keep the show ticking. So I'm about to bring on Macro Alf from Twitter. So let me go ahead and share his Twitter in the chat. You may see him on Twitter. Just a great follow on Twitter if you're not following already, if you're interested in macro. So he's got about, let's see, almost 200,000 followers, tweeting a lot about things like the bond market and Fed fund rates. So if, you find yourself like me and you know your Twitter's full of a lot of like active traders and people talking about this stock and that stock and these calls and that puts, it's good for me. I love Macro Alf's account because it's a nice switch up. I get a more like holistic view of the macro environment, of the market, of what's going on. He's got his own newsletter. So without further ado, let's give Alf our very special introduction and bring him on. Alf, how's it going? Welcome to Benzinga Live.
Hey, Aaron. Pleasure to be on Benzinga. Heard some good stuff about the program. Happy to be here.
Yeah, well, it's a pleasure to get you on. Like I said, you're one of my, and I'm honestly here, you're one of my favorite follows on Twitter. Let me go ahead and share my screen and get your Twitter pulled up because I have some questions before we get started, just basically on your background, how you got into investing in the first place. Because I noticed in your bio, it says former head of a $20 billion portfolio.
That's true.
That's true.
Up until 6 months ago, I was running a $20 billion portfolio for a large European bank. That is correct. And I've been doing that for like 8 years. But at some point, to be honest, Aaron, I just found myself closed in my cubicle, having to make money for the bank, which was okay, which was a nice experience, I guess, for a while. But I wanted to share a bit more with the world, which wasn't really allowed, let's say, or exactly my job description. My job description was just to make money for the bank. Wanted to change that, share a bit my view. That's why I opened the newsletter, the Macro Compass, free. Everybody can read that. 70,000 people subscribe there, a Twitter account. So if you guys want to check out my thoughts on macro and investment ideas, you can always do that now for free.
Yep, and let me go ahead and share that Substack link in the chat as well. And I've actually talked to a few people, you know, in that position, Alf, where they were in a position where they were working for an investment bank or managing money and have transitioned more into, you know, just writing a newsletter or being on YouTube or being in like the financial media space. What do you like more about being kind of in the media space than being in money management?
Oh, so big times like being here with you, for instance, or having these kind of conversations, which obviously you can't have. You are much more open to feedback from people. So if you have your own view, your own bias, which is always very dangerous in markets, you can really cross-check it much more often. So it's a much more open environment. The second thing is you can educate. So if you got some skills, some experience in markets like I do, you can share it with a lot of people. Can make an impact actually when it comes to risk management process from most people and education, monetary mechanics, how the bond market works, and all of that, which honestly from the other side you can't do. And actually I just asked myself at some point, you know, what do I want to do with my life? And it seemed to me that actually educating, checking my view against other people, trading my own money more freely was actually what I wanted most, rather than just, you know, a fancy job title and running a lot of money for a bank.
So, yeah, and I love that. Something I'm curious about, Alf, is your, you know, well, first, what country in Europe are you joining us from?
So today from the Netherlands, but my accent has probably given that away already. I'm Italian, very often in the south of Italy, actually, but today from the Netherlands.
Okay, awesome. So how, because I follow you on Twitter, and I feel like the majority of the time I'm seeing you tweet about, you know, the Federal Reserve and US stocks and US equities. Have you always been more focused on the US side than the European side?
The answer is yes, Aaron. That's because of the design of our monetary system. I just tweeted literally right now at Macrof on Twitter a chart that I think we can have a look at. It explains why my focus is on the US, amongst other reasons. There are $12 trillion. It's quite a big number of dollar-denominated debt, which is issued by foreign entities outside the US jurisdiction. So what that means, Aaron, is that this is like, I don't know, Turkish corporates or a Brazilian bank or even a European bank, for instance. They would just, or a European corporate, they would issue dollar debt and they don't have any access to dollar liquidity unless they actually make money in dollar, which means they trade goods in dollar, they sell their services in dollars, something like that. All nice and dandy, unless the economy slows down or the US stops supplying these dollars. They do that via printing deficits year after year. Once they stop doing that and the economy slows down, then if the dollar appreciates. And that's exactly what we're seeing right now. The dollar is a wrecking ball, and when the dollar appreciates, it has an impact on all asset classes out there. Stocks, commodities, Bitcoin, anything. So because of the design of the system, I have to pay attention to the dollar. The US has the reserve currency of the world. It has the largest capital market, most liquid capital market in the world. I need to pay attention to the US item from Europe.
Got it. Yeah. And I think that's interesting. It's always interesting when I talk to someone like yourself who's, in finance, in economics from Europe. And then like sometimes like yourself knows more about the macro economy of the US than I do. And so I learn about the US economy from you.
Wow, that's very kind of you. But indeed, it's just really, you need to spend a lot of time in looking at the US economic cycle, US monetary policy, because it has such a large impact on anything else. You can't just avoid that.
All right. So Alf, I'm going to ask you a kind of hard question. Are you ready?
Sure, let's go.
Or maybe it won't be hard for you, but I don't know. I'd have a hard time answering this. What would you say your like economic school of thought is, or where do you fit the most?
Oh, that is really tough.
See, I told you. You said you're ready.
You can see my shirt. No, sorry, I'm indicating the wrong side. It says central banks actually print bank reserves, not money. So that is quite a school of thought that actually was prevalent before the 1920s until we got instructed at university, basically the fractional reserve banking system and post-Keynesian economics. And there are certain side of that kind of economic theory which are correct, but the premises are just wrong. So it is very difficult to identify yourself. I'm in the credit camp. The credit-based economics is what was taught, and it's actually the correct economic model for our system before the 1920s. So Aaron, to make it simple, the guys who print money, the money that you and I spend, the money that end up on corporate's balance sheet, the money that runs the real economy, is not central banks. It's commercial banks when they create loans. When they make loans, they create money out of thin air. And the second is the governments. Every time the government makes a deficit, it makes a hole in their balance sheet, and they just send you a check, or they lower your taxes, and all of a sudden you have more money. So while everybody's obsessing about central banks, they are a very important tool, let's say financial tool for the system, but they do not print money. They print bank reserves. They get stuck in the interbank system. They can never get out. And I've seen this from the inside. I've been on the other side of the Fed trades, literally. And I saw that, and it's just a revelation when you're able to understand it. Other people together with me, I'm not just this crazy guy with this crazy idea. Even the Bank of England, a central bank, would subscribe to this theory. Professor Steve Keen, Richard Werner, other eminent professors actually know that banks and governments print real economy money, while the central bank prints reserves, which is quite a different animal.
Yeah, and that's what I think was so interesting during COVID, when the Fed, is like making all these crazy moves and stuff, and you have like these people tweeting these crazy charts of the money supply, and then I would see some economists come out and saying, not quite so fast. It's not like the Fed is just, printing billions of dollars out of nowhere. They're just tapping into future reserves.
Mm-hmm. So basically, what happened during COVID is something unprecedented, Aaron, which is the government of the United States printed $5 trillion in deficit. 5 trillion. It's like 25% of US GDP. It's gigantic. And so the Federal Reserve obviously accommodated that policy by doing quantitative easing. But the real guy who printed money right there was the government. The government literally sent checks at home. It said, hey guys, here is more money. You don't have to pay rent, by the way, and here is more money you can spend. That is what creates inflation. If the Fed would have run 5 trillion of QE and would have been no government spending, just the Fed doing QE, it's exactly what Japan has done for 25 to 30 years. Have you ever seen inflation in Japan? Japan has been doing QE year after year after year after year. And this idea that quantitative easing means there is a certain quantity of bonds you buy, and then at some point inflation will pick up, it's just ridiculous. Japan has been doing that for 25 to 30 years. And because banks don't lend money and the Japanese government is doing deficits, but not to an incredible extent, inflation never picks up because the Bank of Japan, QE, basically creates bank reserves. And you and I cannot use these bank reserves. We can't pay bread with it. We don't. What are bank reserves for us? Like, it's like a laundromat token. I can't do anything with it. It's the government who needs to print the money for me to have let's say, less taxes and more disposable income, or simply a check sent to me, so I have more purchasing power and I can spend. That's exactly what happened during the pandemic, and that's why we saw inflation picking up. This distinction is important. There's an interconnection, an interplay between governments and the Federal Reserve. Everybody obsesses about the Federal Reserve. Very little people are paying attention to what the government does or commercial banks do.
So basically, let me try to get this straight, and correct me if I'm wrong. You're saying the quantitative easing, i.e., the Fed cutting rates, like what Japan's been doing, won't necessarily lead to inflation, but because the government created more money, increased the money supply, that's what led to inflation?
Yes. I'm saying if the Federal Reserve would have done QE, but the government would have done nothing. So say there is pandemic and they say, sorry, guys, I'm not going to hand over any fiscal stimulus. Nothing, Aaron, just nothing. You guys on your own, you figure it out. And the Federal Reserve would have come in and done the same QE that they have done. You'd have seen basically no inflation. And why? Because the amount of money that we can spend, Aaron, would have not increased because the government wouldn't have sent us checks, wouldn't have stopped rent payments, wouldn't have gone to banks and told them, you can lend money to Aaron, even if he has no job, even if the economy is actually shut down. If he can't pay you back, me, the government of the United States, I would guarantee that credit loss. That incentivizes banks to give you credit. And as they give you credit, your bank account goes up. And as your bank account goes up in value, you will probably spend some of that money. There was too much of these bank accounts going up in value, $5 trillion and more, and that caused inflation all at once. But if that wouldn't have happened and the Fed would have done only QE with no fiscal intervention, no bank lending, I can guarantee you, and Japan can tell you already how that works, and even Europe from that extent, there would have been no inflation. It's all about government deficits and bank lending and credit creation.
Yeah, and it sounds like hearing you talk about QE and Japan and how Japan hasn't seen much inflation over the past 25 years. Like that sounds like a lot of what I hear, economists that are more in like the MMT camp, how they speak of QE. Do you subscribe to that, thought at all, or do you?
MMT is a very aggressive, I think, economic standpoint. The MMTers are right in assuming that it's the government itself that actually prints the money and makes sure that the private sector gets more resources. It's intuitive if you think about it, Aaron. The government is the issuer of the currency. They decide that the currency is the dollar, it's worth X, and they have the power to back that up and to make that legal tender. They have the power. The Federal Reserve is the financial arm of the government, let's say. So they are therefore mostly for financial stability, setting interest rates, making sure banks don't go belly up, right? But it's the government who's the issuer of the currency. If the issuer of the currency says, I want more currency, so let's say I will do deficits, I will just print more currency, they can. And all of a sudden, you will get more currency on your bank deposit as the private sector. You will get more money. Your amount of disposable income, spendable money will go up. So from this perspective, the MMT is right. They're looking at the right actor. What they're wrong about is that they assume that they assume the government is sort of a superpower. So they can just open the tap and close the tap at exactly the right time. If inflation is overeating, they can just stop spending money, taxing people, and everything will come back automatically. And in reality, the financial system is much more complex than that. But they are looking at the right actor. They are looking mostly at government spending, which is effectively what increases or decreases the resources for us, the private sector. And we are the guys, we go out and buy goods, we buy services, or we don't buy them, and therefore we contribute to economic growth and inflation.
Yeah, and I love that because I think, a lot of times I see people in economics arguing, and so it's good to see or hear you, I guess, explain something like about MMT, what you think they get right, what you think they get wrong. I think part of what I like about some of the, MMT school of thought is like the idea of just trying to maximize, I guess, the what our economic potential would be by, with the government investing as much possible. Because I think in times, especially here in the US, in the past, we've limited our production and limited our economic growth in the name of limiting that deficit, or saying, okay, we need to keep rates here, instead of saying, no, let's invest more. Let's do more.
So what I love about MMT is that they tell you that debt is not wrong per se, Aaron. And they're right. Debt and leverage, getting money under credit, let's say, it's not wrong per se. It depends from the use you do of these proceeds. So if you borrow and you increase your leverage, what are you going to do? What are you going to invest in, right? That's basically what defines at the end of the cycle whether your leverage was successful and productive. In Europe, you talk about the US. You want to come to Europe, the Netherlands, Germany, Finland, Austria, all these Northern European countries, they have sacrificed an immense amount of productive investment and growth in the name of austerity. In Europe, there was this austerity period between 2013 and between 2013 and 2020, before the pandemic, you can say, where for 7-8 years, governments have run surpluses year after year, and they've been proud of running surpluses, which means literally they didn't spend money that they could spend in a very productive way to foster their economic growth long term, to lower unemployment, as you say. And so MMT, I think, does very well at waking up people to the fact that that is not bad per se. It depends from the use you make of your leverage.
100%. And that's why, I mean, from really the basis of like being an economist or studying economics, you're looking at how to allocate resources. Like the best way, like a utilitarian approach would be, all right, let's look at how we can best allocate resources for the best possible outcome. And that's why, like, you know, again, here in the US, you know, for years and years and years, like we were running a big deficit spending on wars and in the Afghanistan war and all this. And we didn't really see runaway inflation. And then in 07 and 08, when we had this big recession, you had all these people saying, oh, we can't spend this money. We can't raise the deficit. And it's like, all right, well, we're fine raising the deficit for a war and we don't see inflation, but God forbid we raise the deficit for. So I think at least in the COVID, the Fed's actions during COVID had a little bit more, you know, that they were a little bit better at providing some stimulus for like everyday Americans rather than in 07 and 08. They basically just bailed out the banks and the car companies and said, oh, you're on your own to everyday Americans.
Yeah. And so the government, I think, intervened very, very strongly. And one might argue at some point a bit more strongly, like the last package in 2021, with hindsight now, was too large. I mean, you now see the effect. Some of the effects of that was that people had so much money to spend at some point, all of a sudden.
That Bitcoin got all the way up to $60,000.
I mean, at some point it was really huge, Aaron. When I was looking at these numbers, I'm like, holy crap. Like in March 2021, we ended over in the US a large amount of fiscal stimulus while there was already a vaccine that was basically covering 40 to 50% of the US adult population. So if you think about that, it's like, hey, the economy is going to reopen, and nevertheless, we are going to continue, you know, basically throwing money at people, spendable money, like literally increasing their bank accounts. And so with hindsight, some of that was too much. And we are seeing the effects of that. It contributes to the inflationary pressures we're seeing today. Because if the amount of goods that is available out there actually isn't increasing, Aaron, but the amount of money that can chase these goods has increased because of what we just discussed, then, hey, 2 + 2 = 4, the price of these goods has to go up. And that's exactly what we saw, right? In the first phase of the inflationary pressures, goods prices went through the roof because services, I mean, leisure, travel, and all of that were more still hampered or impaired by the pandemic. But the problem is that once you set inflation in motion, it is very difficult actually to slow it down. So now from goods, we are moving to services. We're moving from rent of shelter. We are moving to more sticky part of the inflationary curve, which are getting persistently high as well now. And then the Federal Reserve freaks out, obviously, because they have to intervene and put themselves ahead of the curve. And it doesn't matter if they're going to put the equity markets down by 30%. It doesn't matter even if unemployment rate goes up. They told us they are okay with collateral damage because their objective number 1, 2, 3, 4, and 5 is to actually slow down inflation here.
Yeah, and I mean that's why, you know, Powell doesn't want to come out and say that we're okay with some people losing their jobs, but if you read between the lines and you infer what they're trying to say, that's exactly what they're trying to say, and you can't really have that right now without, you know, at least some uptick of unemployment and you know, pain out there. So we shall see. And Alf, by the way, I know you might have to run, and that's completely fine. I know I said 15 minutes, so but I've got about 2 more questions if you've got about 3 more minutes.
Yeah, we can do that. Let's go ahead.
All right. So what about in terms of their I've been seeing a lot of people out there basically arguing that the Fed raising rates right now really won't do as much to fight inflation as they would hope because the inflation is more driven from the supply side than the demand side. What do you think about that argument?
So that's a fair point. But if you're the Fed, what are you going to do? And this is one of the
You're
rhetorical
gonna do
questions.
you,
Yeah.
right. If you're the Fed, you have one tool in your toolbox. You're gonna open your
I mean,
toolbox.
you have to imagine these guys having a bazooka here, big one, and they can shoot. And that's the only thing they can do. So what are you going to do, Aaron? You have inflation at 9%, and you're going to be philosophizing over whether it's a supply-driven, demand-driven. Inflation at 9% is just like, I got to do something here. So they have one blunt instrument, which is interest rates and quantitative tightening, by the way. So they're going to shrink their balance sheet. That is also an instrument they have. We can explain maybe in one of the next charts how does that work, but they are going to shoot. They have no alternative. So the argument is right. I think in principle some of it is right, but hey, they don't have any choice anyway.
I love that. Yeah, and that's what I've been saying is it's like they're in between a rock and a hard place. You jack up rates. I mean, it's just tough because, you know, like you said, they have one tool. They have their bazooka right here. That's all they have. They're going to use it. They're going to use it. This is the time to use it when inflation's at the highest point it's been at in 40 years. Yeah. Yeah. And then yesterday, I really loved your thread about the basis point. I think it was when, okay, no, it was another huge inflation point. And I think at one point you were talking about a 100 basis point hike, correct?
Yeah, correct.
So, I mean, what do you think? I mean, like, because at one point, you got to think, all right, if we hike 1%, if that's where it goes, you know, is that potentially like bullish? Because then people are thinking that gets us to rate cuts quicker.
Yeah. So now we enter. I laugh because I know the bond market well, so I know what people are going to be thinking here. So people will obsess about this 100 basis point or 75 basis point. What really matters, Aaron, the most is what we call forward guidance. So Powell will need to come to the wires in what is that, 2 weeks, less than 2 weeks. And he has to tell us, well, A, is it 75 or 100? That's important. But then he needs to tell us inflation print at 9%. It's accelerating. The momentum is higher and higher. It's broader. So what are you going to do about it? And the forward guidance basically means it's going to tell us if, you know, they're going to ask him, hey, Powell, the bond market is pricing you to cut rates in 2023. What do you make of that? And Aaron, the answer to that question is more important than 75 or 100, because he's basically going to tell whether he wants to fight the bond market and he's going to go ahead and keep hiking and hiking and hiking until something breaks, or if he's going to say, yeah, actually the bond market is kind of right. We think we go there and then we'll have to cut a bit. If he goes with the second answer, then you get one of these relief rallies, you know, bear market rallies that we normally see 6 or 7% in a week because everybody's short, and, you know, you get these relief rallies. Earnings will still collapse, in my opinion. If you go on the Macro Compass, my free newsletter, you will see latest article just released 5 minutes ago. You will see actually some earnings projection I have. They're much, much worse than what analysts expect. But still, you can get one of these bear market rallies. But if he answers with the first answer, Aaron, and he says, well, I don't care what the bond market is telling me. I really don't care. I think we need to hike here. I think we will hike until inflation actually is dead. Not only slows down, but it's dead. So till we bring it down convincingly to 2%. If he says that, then 75 or 100 doesn't really matter, because the yield curve will have to reprice, at least at the front end, a higher yield to reflect Powell to be much more aggressive than even the bond market is saying. And then the yield curve is going to invert further. And when it inverts further, risk sentiment worsens. You can see that every time the yield curve inverts, stock market drops 1 to 2%. So it really depends from his answers on the forward guidance more than the 75 versus 100 basis point hike.
All right, so let me make sure I got this right. So basically, in the short term for stocks, yeah, it's going to matter whether we go 75 or 100 at the next meeting. But what you're saying, what the bond market's going to care about more is just the Fed's tone going forward.
Correct. Because what happens is that these will be reflected into 2-year yields, 5-year yields. And these yields, Aaron, are actually what we as the private sector have to face when we borrow. If a corporate wants to borrow to refinance
what the bond market's saying.
Correct.
So what the Fed's saying.
So what the Fed is saying will inform the bond market at the short end of the curve, right? And so when that happens, now, as you see in this chart, Very right. The bond market is very strongly disagreeing with the Fed. So the white line is the bond market pricing, Fed funds futures. I extrapolate the implied yields basically, make some correction to the CME2, which is not entirely precise. So you take this chart and you see that the bond market is basically downward sloping. So it's like, okay, we agree with you, Fed, you're going to be at 3.4% by year end in Fed funds, but we believe you're going to be cutting rates both in 2023 and in 2024, right? And the green line is the Fed dot plot, which is what the Fed told us at the last meeting. They told us it's going to be 3.4 this year, but also higher next year. So you see that discrepancy I highlighted in red in the chart, where next year the Fed says we're going to hike, and the bond market is like, what? You can't hike, we're going to be in recession, forget about it. If Powell comes there and says, I don't really care about the recession, guys.
Right.
I don't agree with you guys. The bond market, sorry, I don't know if I can.
You can curse on here.
Yeah, very good. Fuck you, bond market. I don't agree. Take that 2023 yields, bring them up. Take the 2024 yields, bring them up, because I, Fed, am going to hike. I'm going to keep hiking. I'm not going to stop. Now, what happens in that case is that the bond market is sort of forced to respect the Fed if they really are convinced they're going to hike. So 2-year yields are going to go up all of a sudden, Aaron, and everybody who tries to refinance, I mean, like you, me, corporate, somebody who has a credit card, a car loan, anybody else, will all of a sudden have to face higher borrowing costs. Once again, higher borrowing costs. What happens when we face borrowing costs while the economy is slowing down, Aaron, is that we don't borrow. It's very simple. We can't afford it, right? It's too expensive. And when you can't afford it anymore, then you scale back. If you're a corporate, you don't hire anymore. Actually, at some point, you start firing somebody because your costs are too high. And that's why the forward guidance and what Powell is going to imply for the next year or two is actually more important than if it's going to hike 75 or 100 basis points. All these things are explained. I have a series on the newsletter. It's called the Bond Market 101. It's free.
I was just going to say, maybe on the next one, we got to do like a bond market 101, because I bet there are some people out there in our audience right now that are, thinking this is a great conversation, but they don't really know what we're talking about.
Well, actually, I'm happy to do that. We can just run one of the articles that I wrote. It's if you go on the Macro Compass, you'll find them if you want to start reading them. It's called Bond Market 101 series. I just try to break down the bond market as easily as possible. And I know it's an intimidating beast. It's a weird animal, a lot of jargon, a lot of crazy stuff in there. But actually, if you break it down, it's not that complicated. So, Aaron, if you want, we can do it together for the Benzinga audience next time.
Yeah, let's do it. So it is 1 p.m. now. I will let you go. I know I kept you longer than I said I would, and I appreciate you hanging out. I thought it was a great conversation, Alf, and it was great to meet you. And like you said, I hope we get to continue this conversation, maybe do some subsequent appearances here on the show in the next coming weeks.
Thanks, Aaron, and keep up the good work at Benzinga. See you soon, guys.
I appreciate it. Gavin in the chat saying you should do voiceovers in Hollywood.
Why is that?
Well, he just likes your voice. I don't know. Maybe you could play some sort of like a cartoon, character. I don't know.
Maybe it's the Italian accent. It's very exotic. Probably.
I think so.
Right.
We don't get to hear that a lot here in Michigan, here in the Midwest of the United States.
Fair point. Talk soon to you guys. Ciao.
All right, Alf. Talk soon. I'm gonna upload a clip on Twitter, a 60-second clip of you talking about the bond market, and then I'll tag you. So hopefully you can retweet it later.
Yeah, I'll do that. Ciao, Aaron. Ciao, guys.
Beautiful. All right, guys, that was Macro Alf from Twitter. Let me go ahead and drop his Twitter in the chat so you can give him a follow. Go check out his Substack as well. Just a lot of great info from Alf. I hope you guys enjoyed that conversation. I know for some of you out there, it might be a little bit drier than talking about what stocks are moving and options trades and all these other fun things. But I thought it was a productive conversation. So, all right, guys, that will be a wrap for us today. We've got Money Mitch coming up right now. Stay tuned. This stream will automatically redirect you to Mitch. We'll be back tomorrow a little earlier than normal, maybe around 11 a.m. Eastern. So see you guys tomorrow. Till then, stay green. Love you.
This is Ben